Good afternoon, everyone. Welcome to today's workshop. In this session, we are going to focus on two learning units. The first learning unit we're going to focus on is Learning Unit 6, Inventory. During this session, it's going to be a high-level overview of this learning unit and just the main differences between the two inventory systems and how we account for it in our accounting records. Now, what is very important to note before we even start is that the other principles or accounting principles that we have learned previously in Learning Unit 2, what is being debited, what is being credited, does not fall away. We still have to apply those principles irrespective of which inventory system we are dealing with. So please do not forget what we studied in Learning Unit 2, and then Learning Unit 4 and Learning Unit 5, the journals will also remain the same. The only difference is going to be how do we actually account or record a specific inventory system in those journals. But the principles for your journals, what type of transactions goes to what type of journal, would remain exactly the same. So what we are basically looking at today is we're going to look at the main differences between your two inventory systems and the impact it has on our accounting records. So if we start with the accounting equation, so we go back and recap Learning Unit 2, we talked about the perpetual and the periodic inventory system there for the first time. Now, let's quickly look at what is the main differences between the two systems when we talk about our accounting equation. Okay, so the first thing is, if we look at the perpetual one, the perpetual inventory system, we increase inventory, which is an asset account. Okay, so inventory is being increased on the debit side when we buy something. As soon as we return something or the owner takes goods out of our business, which is also called drawings, then we decrease the inventory account. Okay, so if we say inventory is an asset, that means under the accounting equation, all the transactions that relates to purchasing as well as returns or any stock that has been taken by the owner would go against our assets category. Okay, and then we also said when we make a sale for under the perpetual inventory system, we then decrease our inventory. Okay, so our inventory is going down because we are taking it to the cost of sales. So we debit cost of sales, so we are increasing the cost of sales. Okay, what is also very important to remember is any other costs that were incurred to bring that asset to its present location and condition would also be taken to the inventory account. And that is very important to note. And that is, for example, import duties, any freight that you might have had, any insurance that you had during the travel to your premises, any storage fees that you might have had on the boat on the way to the harbor, for example. Those types of costs would be capitalized or being recorded in your inventory account. The periodic system, on the other hand, we take it to the purchases account. Okay, so here we actually take it to the purchases account. Now, what is different there is the purchases account is actually an expense account, whereas the inventory account was an asset account. Now, this expense account actually affects the owner's equity under our accounting equation. So it will decrease our owner's equity if we purchase stuff, and when we return it, it will increase it. So purchases is increased debit when we buy something, but when we take inventory out of stock by the owner or we're returning some of the inventory, then we will decrease the purchases by crediting that account. So purchases, if we buy it, would increase your owner's equity. I'm just going to write here buy. And if you return something or you remove it, sorry, let me just find my mouse again. Okay, so if we return something, then we would decrease owners, sorry, it's the other way around. Let me just quickly fix this. So if we buy, owner's equity would actually decrease because it's an expense. Where has my mouse disappeared? Okay, so this would actually decrease here. And when we return stuff, it would increase the owner's equity. So it's exactly the opposite than what the expense would do. So for purchases account, it would increase it, but it does the opposite in the owner's equity. Now, what is very important is when we make a sale in terms of the periodic inventory system, we have no adjustment to our cost of sales. Okay? Now, the reason for that is we only adjust the cost of sales at year end when we do the physical stock take and we do that calculation that we've discussed in Learning Unit 6. And then also very important to remember is that any expenses that relate to buying of stock would go to their individual expense account. So under the periodic inventory system, we do not take it to inventory, we take it to an individual expense account. So that would be, for example, import duties would have its own expense account. Carriage on purchases would have its own expense account. So you would take the money that we spent on those to those individual expense accounts. And then when we get to year end and we do the stock take, we take those individual expense accounts and we add them all together in order to work out the cost of sales. Now, if we go to the journals will look exactly the same. So what you studied in Learning Unit 4 and Learning Unit 5 will not change. The only thing that will change is the column where we have inventory or cost of sales. Those are the only two that will change in these specific journals based on which periodic, whether you're under the perpetual or the periodic inventory system. Now let's start with the perpetual inventory system. Okay, so under the perpetual inventory system, we will have a cost of sales column in our cash book receipts, debtors journal, and debtors allowance journal. So every time we make a sale under the perpetual inventory system, we will reduce our inventory and we will actually debit and increase the cost of sales. So we are removing the stock when we sell it out of our inventory and placing it into cost of sales so that we can work out the profit of each sale as we make it, as well as update our inventory balances. So that would mean that the cost of sales would reduce our inventory account. Then we will have an inventory column, but only in the cash book payments, creditors journal, creditors allowance journal, and the petty cash journal. In those you will find an inventory journal when we purchase inventory, whether it's for cash or on credit for the first two. And when we return any inventory, it would go to the CHA. And if we buy it from petty cash, it would go to the petty cash journal. And then we will use inventory in the general journal when we have any transactions, for example, the owner taking inventory out of the stock. We would use the account name inventory when we reduce that amount. Under the periodic, however, there is no cost of sales column at all in the CBR, DJ, DAJ columns at all, because of the fact that we do not account for the cost of sales during the year. We only account for the cost of sales at the end of the financial period when we do a physical stock take, and we then do that cost of sales calculation to determine what is the cost of sales in this business. Instead of an inventory column here, we actually use a purchases column when we have the periodic inventory system. So we take it to the expense account rather than to the inventory account. So those are the two main differences. And then if we've got the general journal, instead of inventory account, we also use the purchases account when we have the periodic inventory system. So the main differences between in the journals is perpetual has cost of sales column, periodic does not have a cost of sales column. Perpetual's got an perpetual in all of the journals, the CBP, CJ, CAJ, PCJ, and General Journal has inventory as their column name or account name, whereas in the periodic system we use purchases rather than inventory. Now if we look at the general ledger, let's look at what is the main differences. So under the perpetual, in terms of the general ledger, we will have an inventory account. Now this inventory account shows all of our entries. So everything during the year that we buy or return, as well as the cost of sales. So it's very important to note that this is a running total. So it is just in time. It shows me exactly how much inventory I have at any point in time. So I'm just going to say running balance here, which means that it is up to date. Every time we record an entry, it shows you the current balance. Now, for that reason, at the end of the year, our closing balance in this account is the actual stock we have on hand. So I'm just going to say stock on hand. Okay, so that means the physical stock we have in our stores, because of the fact that we recorded each and every transaction as it occurred during the year. Okay, now this is not taking into consideration any thefts or damages that might have occurred. This is just based on a theoretical calculation. Whatever we have bought or returned should be what the stock is on hand at the end of the year. Okay, so this is in the base case scenario. Under the periodic, however, we also have an inventory account, but it only shows the opening balance of inventory at the beginning of the year. And then we've got no other entry for that periodic inventory system. So we only show the opening balance, and then we show no movement until we update the balance at year end when we do a physical stock take. Everything else that happens during that year goes to your purchases and your other expense accounts. So anything we buy or return goes to those accounts. So it's your purchases, your carriage on freight, your import duties, any insurance you might have had during the period when we transported those goods to our premises. All of those expenses would be accounted for in their own individual and separate accounts. You will not account for them in the inventory account. Okay, and lastly, we do not have a cost of sales column or cost of sales T account under the periodic inventory system. We do, however, have a cost of sales. Yeah, we do have one here under the perpetual inventory system, but we do not have one under the periodic inventory system. Okay, so that is also very important to note. Now, if we talk about the trial balance, what you would see on the trial balance when we have a perpetual inventory system is you will only see an inventory account and a cost of sales account. Whereas under the periodic one, you would see the opening balance of inventory that remains the balance at the beginning of the year. Then you will see the total purchases in the purchases account. You will see the total additional expenses like your freight on carriage on freight or carriage on purchases. your import duties, any insurance type things, and you will not see a cost of sales account. So there is no cost of sales account on your trial balance. It is only your opening balance and your additional expenses accounts that you would see on your trial balance until we get to year end and we do our close off procedures. Now, if we talk about close off procedures, this we will only cover in Learning Unit 9. So I'm just going to touch on it briefly. In the perpetual inventory system, you will see a cost of sales account. Under the periodic one, because we do not have a cost of sales account, we will have to do our calculation that we've discussed in Learning Unit 6, which is this, which is the opening balance of inventory. We add all the purchases, add all additional costs, and deduct the closing balance inventory to calculate the cost of sales. Because for year end, we want to know what is the gross profit. Now, in order to know what the gross profit is, we first have to work out what is the cost of sales. So under the periodic inventory system, that means we first have to do a calculation to work out what is the cost of sales, because we do not have that account as we do in the perpetual inventory system. And then if we look a lot further ahead, so this is accounting 1B, this is the second semester accounting, we would, for our financial statement disclosure, under the perpetual inventory system, you would have your cost of sales when you work out your gross profit and you present it in your statement of profit and loss and other comprehensive income. Whereas for the periodic one, we do not have the cost of sales. So we will disclose our calculation instead of the cost of sales. So that whole calculation is disclosed where we would normally have the cost of sales line item in the perpetual inventory system. We would disclose it under the periodic one, show how did we work out the cost of sales and present that in our statement of profit and loss and other comprehensive income. Okay, so the last thing I want you guys just to remember, it is only stock, inventory, merchandise that is affected when choosing an inventory system. Now, remember when you account for it, or you have to give the general ledger accounting name, use inventory or stock. Merchandise will be marked incorrectly. So I would rather just you guys use inventory as your terminology to make sure that you do not use the incorrect terms. Okay, and then the rest of the accounting principles will remain exactly the same as what we've done in Learning Unit 2 for the accounting equation, your Learning Unit 4 and Learning Unit 5 for the journals. So the only thing that will change is just how we deal with the different types of inventory systems in those specific journals. But the principles of how to do the journals will be exactly the same. Okay, and the only thing that changes is the names of the columns or the accounts to be used. Nothing else actually changes. So this learning unit basically just explains to you the main differences between the two inventory systems and just the main differences between the journals and the columns that needs to change from one to the other. Okay, do you guys have any questions before we dive into a practical question? If you've got a question, please just type it in the chat function for me.